And so the labor market has led to other changes in the economy around the edges. It hasn't been, something like 2008 where everything just falls off all at once. It's been a little bit here, a little bit there. The media has called it a vibe session because people feel like it's a recession, even though some of the main statistics don't look that way. Like I said, lack of hiring is a recession. That's what triggers it. Some people, I've called it a half recession because of the lack of hiring. That's the first part. Some people have said it's a rolling recession because you have certain parts contract while others are growing, and then others start contracting, and then there's a back and forth. It doesn't seem to want to synchronize into a familiar format of what we would all recognize as a recession. But in fact, all of the pieces are there, and they're starting to slowly begin to not just bubble up from the surface, but actually synchronize and align in that fashion. So that's what central banks are responding to. That's what businesses are responding to. And that's what consumers are responding to from different perspectives. But it all adds up to basically the same thing.
On this episode of What the Finance podcast, I have the pleasure of welcoming back Jeff Snider. Probably doesn't need an introduction, but is at the forefront of modern money and monetary science, specifically on the Eurodollar markets and its impact globally. So he's also the host of the Eurodollar University, which I really enjoy, the YouTube channel, as well as a service as well. So Jeff, thanks so much for coming on the podcast today.
Oh, it's my pleasure, Anthony. Looking forward to it.
Yeah, definitely. It was crazy that I had a look, and I think it's about a year since we last spoke. So a lot's definitely happened over that period of time. And I remember when we spoke there, you were sort of thinking that the recession, it wasn't canceled, it just been delayed. But then I think we've had a really interesting, economic data, all this economic data, it comes out. Some weeks we think, things are finally turning over. Some weeks we think, oh, okay, the economy is still running hot. So I'm interested to hear your opinion on what's really happening.
Yeah, but that's true of every time, right? It's never like somebody just flips a switch and says, okay, it's all the data is going to be awful and we're nowhere in a recession. It's funny you think about last year where we were at this time, and we'll think about where we were or where we are now. And it's pretty clear that things have indeed shifted. It doesn't matter that, the September payroll report came in better than expected. Payroll is unreliable anyway, especially during inflection periods, or certain other economic accounts that might look good intermittently in this month or that month. The entire weight of the economy, not just the United States, but all around the world, has definitely shifted. And there's a couple different ways you can tell, starting with central banks. Where were we last year? Last year, everybody was higher for longer, inflation forever. We're going to have interest rate hikes on into next year, the year before, or the year after, and the year after that. Treasury yields are going to go up into the 5s, the 6s, the 7s, or something like that. So there was a broad consensus a year ago that the economy was doing really well. In fact, it was doing too well. Idea of not just a soft landing, but a no landing, and that central banks would never be able to cut rates. Forget about it. Interest rates are going to have to go higher forever. A year later, we've gone through the summertime where even the most optimistic of economic bulls have realized that, oh, wait a minute, there's something maybe happening in the labor market. The U.S. economy doesn't appear as strong as it did before. Central banks that were higher for longer, suddenly, how fast do we need to cut? I mean, you've got central bank after central bank that was, again, higher for longer, now saying, not only do we need to cut rates, we have to cut rates on an accelerated schedule. Even the Federal Reserve did that. The Fed did a 50 basis point rate cut in September. Now they kind of regret it because it appeared panicky, but the reason they did it was because they saw the same things that everybody else did, including what we see in Europe and Canada and everywhere else. So central bankers that are beginning to accelerate their rate cut schedules, they're doing that for a very specific reason. And it's not because the economy of 2023 survived through 2024. Things have definitely shifted. The fact that you can put, a optimistic case together using the payroll report in the US or GDP or some other statistics doesn't make it as much of a difference as it sounds like. A single monthly payroll report doesn't change the overall trajectory of where things are actually heading. And you can see that in data. You can see that in markets, not stocks, of course, bond markets, curves, and things like that. And you can see that in the behavior of central banks. It's not what the central bankers say, it's what they actually do. So Jay Powell says the economy is just fine. It's on solid footing, but yet they cut rates by 50 basis points and they're going to cut more. So at the very least, they're not as confident as they appear about where things actually stand.
So what's actually happening below the surface of all this?
Well, what's happening is that, we went through a period a couple years ago with an artificial high. After the massive downturn and the lockdowns and everything else, I mean, we went through essentially a price illusion. And the price illusion was that because supply was restricted, the economy was forced to come back through artificial means, government programs, redistribution, that type of thing. And it made it look like the economy was absolutely booming. And a lot of people and a lot of smart people in business actually bought into it. It wasn't just the marketplace, business, commercial agents, companies, they aggressively hired because they thought, well, this is going to happen. These good times that we're seeing in 2021 and early 2020, they're going to last forever. So we better staff ourselves up as much as possible. Let's build out our capacity because these good times, I mean, the governments did it. They finally hit upon the right magical mix of policies that put us on the trajectory to an actual recovery for the first time in 15 years. So businesses bought into what was nothing more than a supply shock. It was a price illusion. And so that meant a couple variable speeds in the economy. Nominally, it looked pretty good, but as most people understand themselves from their own position in it, it left a lot of people behind. So big companies did really well, especially those that were closest to the supply imbalance and the price illusion. Whereas most regular folks, workers and small businesses, were left behind because they lost so much purchasing power due to that supply squeeze. And over time, as the nominal rate of change has slowed down because there's not the same amount of artificialness going through the economy, as the nominal economy slows down, businesses have to then realign their entire business model to a very different reality than the one they were expecting. They were expecting, growth, a sustained rate of growth into the future. And instead what they got was a bunch of nominal growth in the beginning that's slowing down. And then volumes and actual levels of activity never actually recovered. You see the difference when you look at nominal series versus real series. I mean, retail sales or, auto sales is a big one. I just did a video about autos. Nominal retail sales and autos are way up here, but even though they're slowing down, an actual volume of autos being sold are way down here. They're well below where they were in the pre-pandemic period, and they've plateaued and started to fall over. So automakers, they saw revenues surge, but they weren't selling as many cars. Now that revenues are no longer surging and they're not selling many cars, they have to look at their business and say, we've got too many factories. We've got too many workers. We don't sell as many cars and we're not getting the same type of revenue growth from the vehicles that we did before. So basically what happened was the supply shock created these massive distortions and imbalances that looked like a red hot recovery and a red hot economy. And for a while there, people fooled themselves into believing it was going to last. And what they're realizing over the last couple years, 2023, and especially this year, is that it was an illusion, that volumes never recovered. And without that nominal growth, businesses have to look at their costs, and they have to look at their biggest cost is labor. So they've been trimming their cost structure because nominal growth isn't there. That means they've been cutting hours on their workers. It means they're stopped hiring workers almost altogether. We've seen such a low level of hiring. So in short, even though we don't see a massive number of layoffs, the labor market is in deep trouble. And what you find through history is that it's not layoffs that trigger recession. It's actually the lack of hiring. So we're already halfway there. And what happened during the summertime that really triggered the central bank response with rate cuts is they realized the same thing. They thought everything looked fine. And then they these problems began to bubble up from underneath the surface, the lack of hiring, the hours cut, income growths that are slowing way down in nominal terms, revenue growth slowing way down in nominal terms. Suddenly the economic illusion of the last couple of years it's being revealed, and what's being revealed underneath is very different than what people had expected. And it's causing this reversion to not the mean necessarily, but reversion to volumes. We went from a nominal economy where growth was terrific to a volume economy that looks nothing like what people are expecting. And the transition is what we're starting to see more and more clearly now. And that transition may or may not be a recession, but that appears to be what it looks like. And it's one that has been prolonged and strung out over a longer period of time because of the unique circumstances that we find ourselves with.
Yeah, lots of great points there. So as you're saying, these companies might have been earning more, but it was only because they put their prices up higher. It's not because they're actually selling more assets. And that's getting to the point where it's going over the tipping edge where, people can't pay these higher prices, volumes going down, and it's going to have real impact on many of these companies.
Yeah, and that's the hard part here is that Consumers themselves, that's one. I mean, businesses and consumers they're basically in the same bucket, but for different reasons. But consumers were willing to spend as much as they possibly could, even though they had lost a tremendous amount of ground during that price illusion and supply shock. They lost a ton of purchasing power. Everybody knows it. People talk about it all the time. They feel it. They feel it every day, even now. But what kept the economy moving were a couple different things. There was a large increase in nominal incomes in early 2023, for example. When the economy started to really slow down and fell into recession in some places like Europe, the U.S. was supported to an extent by a huge cost of living adjustment in fixed income like Social Security, as well as other forms of wage increases in early 2023 that were an attempt to make up for the past price increases. But it was never enough. But it was enough for that time that consumers were like, even though they complained about lost purchasing power, they continued to spend because they thought, well, I'll get a raise next year that might be just as big. And as consumer price changes slow down, I might actually get back all of that purchasing power that I lost. I just need to hang in there a little bit. So I'll just continue along as I was beforehand. But as 2023 wore on and the labor market you started to see lack of hiring, you see unemployment start to rise because of the lack of hiring. Suddenly people began to get the idea that I thought I was going to be made whole if the labor market continued to be robust. I'd continue to get wage gains. If I didn't like the job I was in, I could go someplace else and get paid a whole ton more. I would find my way back to get back all of that purchasing power that was lost. But as the labor market slowed down because the nominal economy slowed down, as businesses started to look at their cost structure and what they were really selling, they stopped hiring people. They stopped giving wages like they did before. The entire balance of the labor market shifted to employers, and they know it. Return to office policies that were implemented as a way to circumvent layoffs. The labor market completely changed. And for most consumers, what they felt was, I lost all that purchasing power. I thought I was going to get it back. But now that pathway for me get back that lost purchasing power seems to be closing down. So I not only fell behind, now it looks like I'm never going to be able to catch up. And that's what we've been hearing all year so far, is that consumers are really, pessimism has been rising, not because price changes or inflation has been reignited, but because they realize that there is a permanent impoverishment that goes along with this transition out of the supply shock era into where we're going, reversion to volume. And so the labor market has led to other changes in the economy around the edges. It hasn't been something like 2008 where everything just falls off all at once. It's been a little bit here, a little bit there. The media has called it a vibe session because people feel like it's a recession, even though some of the main statistics don't look that way. Like I said, lack of hiring is a recession. That's what triggers it. Some people, I've called it a half recession because of the lack of hiring. That's the first part. Some people have said it's a rolling recession because you have certain parts contract while others are growing, and then others start contracting, and then there's a back and forth. It doesn't seem to want to synchronize into a familiar format of what we would all recognize as a recession. But in fact, all of the pieces are there, and they're starting to slowly begin to not just bubble up from the surface, but actually synchronize and align in that fashion. So that's what central banks are responding to. That's what businesses are responding to. And that's what consumers are responding to from different perspectives. But it all adds up to basically the same thing.
Do you think this is sort of going back to the mean where we were before 2019, or maybe even just after COVID? Or do you think this is sort of something that's going to go even further down as these recessionary trends permeate throughout the economy?
Well, it's tough that's always hard to tell. I start always looking at the curves in the bond market, fixed income futures, that type of thing. Like, what do the curves say? They don't tell you exactly what the future is. I mean, they never really have that type of forecasting ability anyway. So there's always ambiguity in everything. But by and large, what the markets have been saying this entire time, going back to 2021, early part of 2022, the inversions in the curves, swap spreads becoming increasingly negative, especially last summer into this year. What that says is that the market is prepared for a bunch of scenarios, whatever those may be, that lead to a longer term future where interest rates are low and stay low. And that can mean a number of things, but not a whole lot, not a big number of things. And what that essentially means is, like you were just saying, Anthony, is that interest rates that are low and stay low is an economic landscape that looks a lot like the 2010s, sadly and unfortunately. It doesn't look like a robust recovery or what many people were thinking about back in 2021, certainly. But what it says is that growth and inflation expectations are incredibly low, and they're likely to stay there, with the emphasis not on the inflation part, but on the growth part. And so what we've seen develop in the markets, as well as in these macroeconomic statistics, of one payroll report or another doesn't make a difference. You've seen the slowdown. We see the nominal slowdown in incomes. We've seen consumer pessimism that's consistent with a recession. And so it looks like the economy and all the data that we have coming in, or the vast majority of it, certain outliers aside, is moving in that direction. It's moving in the direction of, if A was the supply shock where everything looked good because of the price illusion, and B is something like the 2010s, you can tell we're moving in that direction. Now, how actually we get there, that's, completely up in the air. Does that mean a recession across the world? Does it mean a sharp, very deep recession? Does it mean maybe like Europe has been experiencing, where it's just it's a slow grinding year after year after year, no growth, which is a pretty substantial contraction in its own right? We don't really know exactly how we get to B, but the markets consistently say that we're heading toward B, where rates are going down and they're going to stay there, which is low growth and inflation expectations. And then everything that has happened over the last year, especially in the US labor market, which seemed to be one source of strength, continues to move in that direction. So it looks like the 2010 scenario might be the base case, and maybe it's the best case. We hope it's not the best case, but that seems to be where everything is heading, markets as well as macroeconomic data. And many places are already there. I mentioned Europe, Japan, Canada's another one heading in that same direction. And that's, like I said, that's why central bankers are cutting rates, because they can start to sense the exact same thing. That's why central bankers are accelerating the rate cuts, because the weakness is becoming more and more apparent. And even if we don't know exactly how we get to that destination, that's really where everything seems to be. The weight of gravity in the entire global system is really heading.
Yeah, and it seems like, just as maybe, the average person was going to start getting pay rises, sort of above inflation pay rises, going to get a recession. So it's going to sort of go back to what we're seeing into 2010, where, it's probably going to be this 80% who is going to continue to struggle.
That's really the hardest part, right? Because you think, wages have been good. It seemed like there were at least some decent employment opportunities, and then it's just been slowly turned off. And I think that's the biggest complaint that people have about the labor market. What's having such a big chilling effect across the economy is that, even, like I said, the lack of hiring is a trigger for recession, because it has such a profound impact on everybody, from psychology on down. You think about, you're not exactly happy. Nobody's ever satisfied in the job that they have. And you think, well, I'll go out and find a new job. But then suddenly you see that nobody's hiring. And it's not just that you're no longer optimistic about not being able to find a new job. You also realize that as nobody else is hiring, you're kind of stuck where you are. But then where you are, managers and your bosses they're talking about, well, we're not meeting our numbers. Revenue growth isn't coming in. We have to control and cut our costs. And then you start thinking, okay, I don't like where I'm at. I can't go anyplace else because nobody's hiring. And my employer is starting to talk about cutting costs. What happens if I'm the one who loses hours? Or what happens, God forbid, I'm one who gets laid off? You realize that there's no other place to go. And it has an effect on people who never get laid off, who never actually lose their hours, because they know that there's weakness, and they start cutting back on things because that's the prudent behavior in any type of these situations. So the lack of hiring leads to the vicious cycle that ends up with the recession that we all think about, what we all associate with recession. It's not just about those who lose their jobs, because it's really not about losing their jobs in the first part of it. And in this particular context, where we're coming off of these artificial distortions the last couple of years, it's potentially a much bigger deal, because not only are you closing down the labor market, there's lack of opportunity, potential for lost income. You also have to factor in the fact that, like I said before, the lost purchasing power. People are so much further behind than they were a couple years ago. And now that they know they're further behind, and now that they know that they're probably never going to catch up, that can lead to an even worse adjustment period, where we're talking about a real retrenchment in consumer spending, and leading to all sorts of negative consequences from that. And there's also the same thing from the business side too, because businesses realize, even those businesses that had done really well in 2021, 2022, they realize, things were good a couple years ago. We had tons of revenue growth. Automakers are a perfect example of this. It was really good for a while there. We got so much more revenue, even though we didn't sell as many cars. Now without the revenue, it's like we don't have any work for these people to do. Why do we hold on to them? And now that we see that the rebound, the recovery that many people were expecting for this year and into next year, okay, it wasn't so great in 2023. It's not so great in 2024, but 2025 will be much better. As the idea of a 2025 recovery starts to fade away too, businesses really do look at, okay, we don't sell as many cars, or we don't sell as many, we're not our service provider. We're not selling as much service as we did before. We need to start getting rid of some of these employees. We just don't need them. As much as we didn't want to fire them before because we were afraid that when the economy zoomed ahead again, we wouldn't have access to workers that we need. Now that we realize the economy is not zooming ahead and it's not likely to, we have to look at what do we need all of these workers? Do we need all of these facilities? And so there's not just the hiring freeze, there's cost cutting, there's lack of investment in the real economy. All the stuff that supports long run economic growth suddenly starts to reverse. And it doesn't reverse all at once. It's a process that takes time. And that's what we're starting to really see in more obvious fashion here in 2024 and heading into 2025.
So do you think the Federal Reserve's sort of rate cuts, is that too little too late? Or if they continue to do 50 basis point cuts, do you think that's sort of going to help liquidity permeate throughout the economy?
Rate cuts don't do anything. It's one of those things that you really wish people would go back and look at, recession history. Since the Federal Reserve started targeting interest rates in 1982, that was too late for the 1981-82 recession in the United States. But interest rate cuts don't solve recession problems. In fact, whenever you see a central bank cut interest rates, that's not a solution to the weakness; it's a reaction to it. So you'll go back in, any number of cycles. 1990, 1991 is the first instance where the U.S. used interest rate targeting specifically to try to keep a recession at bay. And so Greenspan started cutting interest rates in July of 1990, but the real rate cut started later in October. And so Greenspan cut rates, rates around 8% when the recession began. And it got all the way down to 3% several years after the recession because there was a recession and there was very little recovery after it. They called it the first jobless recovery for that reason. So even though the Federal Reserve cut rates by about 5 percentage points, we had the recession and very little recovery following it in the labor market. Same thing in 2000, 2001. The Fed aggressively cut rates by 50 basis points 5 times in a row. In fact, the first 2 rate cuts were in the same month. They did an intermediate cut in January of 2001, and then another one a couple of weeks later at the regular meeting, and then 3 more 50 basis point cuts over the next 3 meetings. And we still had the dot-com recession anyway. Not only did we have the dot-com recession, there was again a jobless recovery afterward. So the Federal Reserve brought interest rates down all the way to 1% by 2003, and the unemployment rate was completely detached from rate cuts. There's an inverse correlation between central bank rate cuts and unemployment rates because central bank rate cuts are a response to rising unemployment, not a solution to it. Same thing in 2007, 2008. I mean, set aside the banking panic and everything else, rate cuts didn't help there either. So there are only a couple of cases where proponents of interest rate reductions point to as saying, okay, these are effective. 2019 is an example. Though we never know for sure what would have happened. The Fed started cutting rates in 2019, again, in response to developing weakness. We got inversion in the yield curve, recession scare, everything in 2019. We have no idea how that would have turned out. I'm betting, and the markets all bet, that it would have turned out like the past recession scenarios. But there's some other ones, such as 1995 into 1996. The Fed cut rates a couple times. But there was no real danger of a recession at that time. This is the middle 1990s, very, very different circumstances that we find right now. So interest rate cuts are not stimulus. They're not liquidity. There's no liquidity involved here. There's no actual positive impact from interest rates. It's mostly about trying to engineer some form of positive psychology and optimism, hoping that psychology and optimism will be the solution to whatever weakness is plaguing the economy. And with most people, most certainly in the business community, understanding that rate cuts are not actually a solution to weakness, it doesn't have the effect that most people that are led to believe, because that's what we hear all the time. Rate cuts are stimulus. Rate cuts are stimulus. Rate cuts are stimulus. When every example that you can look at that shows that rate cuts don't do anything. China is another perfect example. The Chinese have been cutting rates for years. They've been cutting rates since 2014. Rates only go in one direction, the same direction the economy in China is going, which is lower and lower and lower. So bottom line is rate cuts are not stimulus. They're not a solution to weakness. They are a reaction to it. And so when you see central banks start to cut rates and start to cut rates more aggressively, that isn't a positive signal. That's actually a sign that they're beginning to see the weakness too and respond to it. So the faster and more aggressive that central banks cut rates, the worse it is and is likely to be.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views with hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student. I'm now currently working and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening. And let's get back to the show. Yeah, and that's definitely the way it's going now. So you'd say fiscal support is more what is required to sort of kickstart an economy.
I'm not sure fiscal support would work either. I mean, look, there's the 2021 example, which is a unique set of circumstances that I don't think they don't necessarily. I mean, we have any number of other contrary examples that fiscal spending doesn't actually solve the problem anyway. There's usually a short run impact to it. But unlike what is expected, where you're supposed to have a positive multiplier, which means it has knock-on effects that continue, the government spends money or the government gives you money to spend in the real economy. There is a sugar high, there's a short-term impact. What's supposed to happen is as you spend money or as the government spends money, and it doesn't matter what it is, the Keynesians don't care, aggregate demand to them is all the same. As aggregate demand rises from that initial fiscal spending, it's supposed to lead to other spending, because now that businesses have more revenue because people are spending, that means they're going to hire more workers. They're going to invest in their facilities. They're going to do all the things that we associate with economic recovery. But as we just saw, and what we're talking about here with this, even with the supply shock period, businesses did all that. People did all that. There was a short-term impact in terms of spending. But what we're finding out is that it didn't have the lasting impacts that everybody associated with. And that was a gargantuan fiscal program, set of fiscal programs. There's all around the world. Instead, what you see is that outside of that one case, any number of fiscal programs in any number of places around the world lead to the same thing, which is the same thing as rate cuts. It's ineffective. We see that everywhere. China, again, perfect example. The Chinese continue to do more and more fiscal as well as monetary stimulus. And all it leads to is them having to do more fiscal and monetary stimulus. It doesn't lead to the economic recovery and growth that people associate with the term stimulus, because it's more about the terminology and the psychology than it is about any actual real tangible economic impacts. And it's not just China. You can see, Europe, the United States, the ARRA bill in the US in the immediate aftermath of the 2008 crisis. Did that lead to recovery after 2008? Of course it didn't. There was maybe a temporary impact, but over the couple of years that the government spent all that money, it didn't lead to exactly what it was supposed to. It didn't lead to a recovery because there never was one. Instead, we ended up in the 2010s. Japan over the last 35 years has been the best example of all this. They've tried every different form of fiscal spending, and in very different doses, and bigger, smaller, money finance, deficit finance, doesn't matter. The Japanese have done it, and it hasn't gotten them out of their deflationary rut in any point along the way. So part of the problem that we have is that we're conditioned to always look for the government to solve these problems when the government has no ability to do so. And the government's really not interested in solving the problem. The government is just interested in getting you to believe that it is, doing something for the sake of appearances. Oh, we're going to cut rates to help the economy, even though rate cuts never help the economy. But people, the Fed's cutting rates, so that must be good. We're going to spend money out of the fiscal authority, even though spending money out of fiscal authorities doesn't lead to the economic recovery that everybody hopes. The problem is, one of the big problems we have is that whenever we're confronting these issues, we're told to look government, 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 government. And there's no stimulus plan. There's no monetary plan that's going to fix these problems. It's not up to the government to do so. We need to look into the real private economy to see what's actually wrong, and then allow private solutions to take hold and fix what's really happening. It's not the idea, government. It's one of the most frustrating aspects to everything, because it's almost reflex at this point. Okay, the economy's starting to get weak. Okay, what central bank or what fiscal plan is going to save us? And it doesn't save anything. It creates this illusion that everybody wants to follow. And it's one that is, it's understandable. We want to believe that authorities, first of all, have our best interest in mind, though I think most people realize that's not the case. And number two, they want to believe that, okay, they have the ability to fix the economy, because if you believe that governments and central banks have the ability to fix an economy, it's a much more pleasant place to live in than thinking and really understanding that they don't have that power, and that there is actually that level of uncertainty is a lot more uncertain than people really appreciate.
Yeah, it does seem to be very linked to this psychological and the sentiment. That's really what drives these movements. And if, what we saw in Japan, what we see in China, if the sentiment's not there, it doesn't matter what you do. It's just not going to change.
Yeah, and it's just, but that's always the reflex, the impulse. Whenever something goes wrong, who's the first person you see on social media? It's Jay Powell's face. He has no idea. He doesn't know what they're doing. The Fed doesn't have the ability to solve these problems. They're always behind because they don't know what's happening as it's unfold. And then, we're pre-programmed to buy into all this stuff because it benefits politicians and governments for them to get you to believe, and to really, anytime the economy encounters a rough spot, if you believe, okay, I need to think about what is the government going to do to bail me out, or what is the government going to do to fix this, that only serves government goals, not necessarily the private economy. And it also takes away focus from what might actually be wrong. We never talk about it, right? Why is the economy heading into a rough patch to begin with? Oh, we don't care because, Washington's going to spend a bunch of money and save us. It takes away focus from where it needs to be. So it's not a neutral proposition either. Government spending is in many ways harmful. And not just in terms of, taking focus away from what's really wrong. There's also it's not a neutral proposition where governments come in and they distort the economy. Let's face it. Government distortions they do actually harm the system, because you're getting businesses conditioned to, instead of chasing real profits and opportunities in the real economy, instead they start to refocus on, okay, the economy's bad. Where's the next handout coming from whatever central authority? Instead of focusing on legitimate and sustainable business, you're always chasing the next stimulus check. That's one of the biggest problems that's plaguing the Chinese economy right now, is that as the private system gets worse and worse and worse, businesses orient more and more and more to whatever Beijing is going to do next. That doesn't help the long-run prospects of the system. So it's worse than just, okay, we'll spend a bunch of money by the central authority, and then, it just, most of it will be wasted, and that's, there's no real downside to doing that. There actually is a downside, which is one of the reasons why the Japanese example is the most potent one. What they show is that it does completely change the orientation, at least at the margins, of the entire economic system away from where we need it to be, to instead looking more toward what's the safest return I can get from the next government program that inevitably is going to end up being used, because the more government does, the more inefficient the economy becomes, which means the higher the chances that the government's going to have to do more, because that's why we get into these constant stimulus cycles, because they never stimulate a private recovery. So you get Economy falls down, government spends a bunch of money, it's inefficient, it's wasted, it distorts the economy, makes it more inefficient, which means the economy is going to continue to be rough and bad and well below potential, which only means the government's going to do more, which causes even greater harm and then leads to more government intervention and then greater harm. That's why we've been in this constant government spending, low interest rate cycle over the last 15, 16, 17 years, because it doesn't solve the problem. It just leads to the next inevitable government intrusion.
Do you think this blows up with the sort of the bond market and concerns about deficit, or is this more sort of have to be through voting and change from government? How do you see this happening?
Yes, sadly, the idea of bond vigilantism is, I mean, it's understandable where that comes from. I don't think there was ever bond vigilantes to begin with. But what has been shown emphatically over the last couple of years is that no matter how ridiculous and how insane, especially the US federal government has become, there is demand for the treasury market, treasury debt that comes out of it, which raises a whole bunch of issues that I wish more people would try to understand and appreciate. If there is overwhelming demand for safety and liquidity, and I understand that it doesn't seem like treasury should be safe and liquid, but when we talk about safety, it's really about the liquidity aspects more than the credit profile of the issuer. So the demand for U.S. treasuries seems to be there, regardless of the deficits and the amount of deficit spending, which should be an alarm bell that rings in your head, as we were talking about before, going back to the 2010s. Overwhelming demand for safe investments and safe instruments is not a good sign. And the thing is that politicians in Washington have figured this out. It took them a long time, but they finally figured out that the bond market in the state that it's in will buy as many treasuries as they want to issue. So there really is no constraint on the federal deficit. Now I'm not advising this. I'm not saying this is a good thing. What I'm saying is we need to understand that this is the case. As long as the bond market demands safety and liquidity because of the economic climate and some financial risks as well, then the government can continue to borrow and borrow and borrow as much as we want. That's the Japanese example. We're following the Japanese path almost exactly. And what that means is, as you were saying, Anthony, the solution to that is we got to stop looking at the treasury market. I know people say this all the time. The treasury market's going to blow up. The government's going to issue so much debt that treasuries won't be able to absorb it. Well, we've seen that in practice. Over the last couple of years, the amount of deficit spending, the amount of debt that has been raised over the last couple, it's just mind-boggling. Outside of any type of emergency, we've gone completely insane. Yeah, but where are interest rates? Interest rates today are lower than they were 2 years ago, which tells you that the deficits did not matter. What did matter is demand for safety and liquidity. So the only way to put a stop to this is at the ballot box. We got to stop thinking the treasury market's going to blow up, because it's proven time and again that it's not, that the demand for safety and liquidity is the overriding factor, fundamental prospects and fundamental valuations and interest rates. And that means that any chance to stop the government from continuing to harm the economy through its reckless fiscal spending, it has to be a political solution, not a market solution.
Yeah, which doesn't seem well. There's lots of rhetoric about it, but we'll see if any of that actually follows through, or if the people are voted in.
You know how this is, man.
Yeah.
I mean, politicians, it doesn't matter what party you are. This is not a partisan issue. Both parties are equally bad. Well, maybe not equally bad, but both parties are legitimately bad. And politicians want to buy votes. I mean, let's face it, that's what they wanted. I mean, the safest route to re-election is to buy the electorate off. And since politicians have figured out that they can borrow as much as they like, given these circumstances, they don't care about the economy. They don't care that it sucks and it's getting worse for most people. They're only looking out for themselves. And so they have this ability to buy votes and gain power through their increasing budgets. They're going to continue to do it. There is no appetite on either side to address these deficits. And so I know what people, I mean, the entire idea of inflation, as well as rising interest rates and really soaring interest rates, was one of those ways in which you think, okay, this has to come to an end. There has to be a way to get Washington, to rein Washington spending in. They're going to break the treasury market. They're going to unleash a 70s style inflation again. Something in the marketplace or the economy would have to adjust, or would have to be broken by the way in which the federal government is behaving. And so the last, really going back to 2008, 2009, we've been hearing these constant assurances or constant forecasts that the treasury market's going to blow up. There's got to be a limit to how much debt the government issues. Inflation has to come, and it's going to be worse than the 1970s because of what's happening in Washington. And year after year after year, that never happens because those problems are not primary in the marketplace. And yes, the prices did go up in 2021 and 2022, but that was the supply shock, not because there was too much debt issued. As I said, interest rates are going lower despite the fact that all the market debt that has been issued, or all the debt's been issued in the marketplace. So the fix to this is a political fix. Somebody has to have enough what would be the word, enough lack of outside of self-interest. I mean, that's really what politicians are doing. They're vote buying, they're gaining power, they're increasing their budgets for their own self-interest. So you have to have somebody who's not going to get caught up in all of that stands apart from it and says, yeah, we need to fix this and make this a major issue that the voting public can latch onto. Because right now, voters are just as bad as politicians. No, there's no appetite among the electorate to tackle these fiscal problems when there really should be. And part of the issue is, as we were just saying before, because nobody connects the dots here. The economy gets bad. Nobody says, well, the government spending is a part of it. Well, some people do, but most people don't connect those two dots. And so as the government spends more and the economy gets worse, most of the voting public, their reflexive action is, okay, we need the government to do even more. So we need to break the cycle in a number of different ways, not just to get control over government spending. In many ways, we need to sever this relationship in people's minds between weak economic circumstances and, oh, Washington, come save me. That needs to stop to begin with. People need to associate weak economic outcomes with the amount of government deficits, especially when they call these government deficits, or they characterize these government deficits as a solution to the economic weakness. I mean, the term itself is completely wrong. Stimulus, it doesn't stimulate anything except the size of the government.
Yeah, and it's a bit of an extreme example, but I guess that's what we've seen in Argentina, where the average person just is so fed up with the trajectory of the country that they do this radical change. And you hope that, that might work or not, but then you hope that maybe it happens beforehand. So it's not as radical, but it is the right trajectory.
Yeah, we don't want to go that far, right? We'd like to stop this before we get in that shape. But as I continue to point out time and time again, is that we've been in that shape for the last 15, 16 years, really since 2008. And it's not really about government deficits. It's about not connecting what actually happened, what's really wrong, with what we're doing about it, which is nothing. All we're doing is we continue to go along in this weak economic environment, and hopefully this Fed will do something that bails us out. Maybe the next QE will work, which again, we've seen in Japan. Japan has done 26 QEs by my count. I mean, the reason they keep doing it is because they don't work. Fiscal deficits, debt soaring to absolutely insane levels, and yet nothing changes. It's the very definition of economic and fiscal insanity. Keep doing the same thing over and over again and expecting different results. So it's really getting people out of that mindset and to realize that, yeah, we are living that worst case. And it's not what people imagine. People think the worst case is where you go through an absolute crash where everything falls down and we have to go through something like 2008 again. The worst part of 2008 was not in 2008 and 2009 during the Great Recession. That was not the worst case. The worst part of it was the 15 years that followed it, with lack of economic growth around the world, because that leads into all sorts of other negative consequences that we're now seeing more clearly too. When the economy doesn't grow, people tend to react harshly to that in a number of different ways. Social cohesion breaks down because everybody starts to look out for themselves. It's much easier to cooperate and get along when the economy's working, when it's really, the old expression, rising tide lifts all boats. When the tide legitimately is rising, people are less angry. They're less likely to lash out. And that's also true about large countries and large blocks of people. Why do we see more aggressive behavior by countries around? Why conflicts suddenly become much more violent and much more dangerous? Because economic growth disappeared by and large. It definitely changed 15, 16 years ago. So we're already seeing that path. We just don't realize that we're on it. We already see the consequences, but we don't connect it to why we're living those. Why are we heading back toward the 2010s here in the 2020s? It's okay if we're heading back to the 2010s. Let's do another fiscal program to see if we can see if this time will actually be different, knowing full well that it won't be.
Yeah, I think economic growth doesn't disappear; it just moves to other parts of the world.
Well, there should be, we definitely lived through a period, and if you're old enough like me, we lived through a period where there was legitimate economic growth, where we did have a rising tide lifted all boats. The second half of the 20th century was some of the most peaceful and prosperous times that we've ever seen. And not just in one place or another, especially when you get into the 1980s and 1990s, what was called the Great Moderation, the Eurodollar heyday. During that period, it was legitimately unparalleled prosperity all around the world. You think of some of these emerging market countries that were dirt poor subsistence agriculture, like China. Suddenly they go from that, the great leap forward and famines and Maoism. By the middle 2000s, China is a major industrial power, a rapid transformation. And that's not the only one. That's just the biggest example. So there was a period where growth through globalization did work. And yes, there's always a downside to it. I guess I tell people all the time, I grew up in the Rust Belt. So I saw the downside of this globalization and economic prosperity through the rest of the world. Through where I grew up, it certainly didn't seem all that prosperous, and it really wasn't. That's what capitalism and free markets actually do. Part of that process of growth and expansion is messy. And so there are people who end up with the short end of the stick. That's just the way that the free market capitalism operates. But there is no arguing that during that period, the 80s, 90s, and the first half of the 2000s, we went through a global wave of prosperity that we've never seen before. And after we got the 2008 crisis, it all seemed to just disappear. Well, it didn't just disappear. It was the Eurodollar system that broke down. And now on the other side of it, without the economic growth, suddenly the world looks like a very, very different place. And people are trying to figure out what's really wrong. People are trying to figure out, what do we do about it, when nobody has really taken a hard look in a very honest fashion and said, okay, this is what's really wrong and this is what we need to do about it. Instead, they just throw these Band-Aid solutions out there, just hoping to placate the public long enough to get reelected. And then there's no real political desire to fix the problem, because why would, most of these politicians that are running for office are running for office because of how everything is wrong. So their incentive to fix the problem is even less than it would otherwise be. And so we're left with this sort of, we're locked into this malaise where it doesn't seem like there's any way out of it, because nobody really knows what's going on. Nobody's looking at the real solutions, nor are they really talking about what should be done. It's just complete and utter insanity. It's just do the same thing over and over and over again, regardless of the outcomes.
Yeah, we've touched on so many different parts of what's happening in the world, and I think really important conversations. And so Jeff, thanks so much for your time. Really appreciate it. What is one message you want people to take away from our conversation?
Well, really, it's realize the insanity. It's like, if they keep doing the same things over and over again and you don't feel like it's working, that's because doing the same things are not going to actually help the situation. It's really about looking beyond this reflexive notion that, okay, we might be facing a recession, so let's be happy about rate cuts. Well, rate cuts aren't going to help. Or let's look to the next fiscal stimulus program. The fiscal stimulus program is not going to help, and it's going to make the situation worse. So it's really about taking a deeper look and thinking beyond just there's so many myths and just accepted conventional wisdom that isn't all that wise, that you need to step back and really take an honest look at how things operate, how things are gone, to really see this more clearly. It's not really about a recession in 2024 or 2025. That's not what we're really talking about. As you pointed out, Anthony, really well at the beginning, it's about what does the long run future look like? As I continue to say, 2008 wasn't the worst part of it. The crisis wasn't the worst part. It was what came after it. So if what we're looking at and what the markets are saying about the 2020s looking like the 2010s is accurate, and everything seems to be lining up in that direction, we really do need to stop just accepting conventional wisdom. We need to look way beyond it.
It's a great message. So thanks again for your time. If anyone wanted to find out more about your work and what you do, is Eurodollar University the best place to find it? Yep,
Eurodollar University, either the YouTube channel or the website, eurodollar.university. We've got subscriptions, research. We talk about the Eurodollar system. What is money? What is this monetary system? And what is it supposed to do? And why isn't it doing what it's supposed to do? That's what Eurodollar University is for.
Perfect. I'll put that in the description below, but thanks again for your time.
My pleasure, Anthony.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.